Welcome to Yadnya Investment Academy. Today we are going to see what is asset allocation. Putting your money to work in the best possible way is called asset allocation. It is the collection of investments you own at a given point in time. The kind of asset allocation you choose depends upon your risk tolerance, that is nothing but your risk profile, your goals, and their corresponding investment horizon. You might use different asset allocation for different purposes. For example, if you are within 30 years of age, for a goal like buying an expensive TV, which is 6 to 8 months away, you might put all your money allocated for this particular goal into liquid funds, which makes an asset allocation of 100% to debt and 0% equity for this specific goal. For a goal like retirement, which is decades away, you might choose an asset allocation of 100% to equity and 0% to debt. For a goal like buying a dream car, which is 7 years away, whatever money you set aside for this particular goal, you might choose an asset allocation of 80% equity and 20% debt. Rebalancing is the key aspect of asset allocation. If one asset class of your portfolio gains, you sell some of it to invest into the asset class which has gone down so that you regain your original asset allocation. Let us take an example to understand this better. The goal is buying a dream car after 7 years. And for this particular goal, we've chosen an asset allocation of 80% equity and 20% debt. At the start of the first year, you allocate 1 lakh rupees for this particular goal. And as per our asset allocation, you invest 80,000 rupees into equity and 20,000 into debt. After a year's time, let's say equity gains 15%. This takes the value of equity allocation to 92,000 rupees. Let's say the debt portion gains 8%. This takes the value of debt allocation to 21.6 thousand rupees. Due to these gains, the equity portion out of the 100 is now 80.98% and debt is 19.01%. So, you would have to sell the asset class which has gained, which is equity in this case, and invest into the asset class which has gone down, which is debt in this case, to regain your original asset allocation. So, in terms of numbers, you would have to sell across 0.98% of your total allocations from the equity part and invest the same into debt to regain your original asset allocation of 80% equity and 20% debt. It is said that asset allocation has a greater impact on wealth creation than the actual selection of securities under each asset class you invest in. So the allocation that you keep, like in a previous example, we have kept 80 to equity and 20% to debt. This matters more than what you actually buy with 80% allocation into equities and 20% into debt. Asset allocation is a great tool to reduce the investment risk because we are rebalancing. We are not getting exposed to an asset class which we are not comfortable over and above selected allocation. And thus, it helps you maximize your returns for a given level of risk. Again, referring to the example that we just discussed, rebalancing gives you a point in time where you should book your profits, which otherwise always remains like a big dilemma as to when you should actually book your profits. All the more, the profits stay with you when you change your asset allocation. For example, when your goal comes within 3 years, you might change your entire asset allocation to 100% debt. There are various types of asset allocation strategies. We would learn about these strategies in our subsequent videos. Friends, in this video, we've seen what is asset allocation. We've seen an example where you rebalance your portfolio. We've also seen the advantages of asset allocation. Friends, thanks for watching this video. Watch this space for more such topics. Until then, happy investing. If you have any questions, let us know in the comment section below our videos. And if you like our videos, please do subscribe.